In this video, I'm going to show you how to 3, 4, or 5x your profits just by making 2 simple tweaks. Hi guys, it's Prince. Welcome back to the channel, and I've got something special for you today. So I've been doing some back testing the last few weeks, and you know, that boring stuff that every trader needs to do, but nobody likes to do. Yeah, I was doing it again, and this is my 12th year of trading. And I saw something really special I'd like to share with you guys that actually increased my profits. And that is concerning trend following. So a lot of you know me as a trend continuation trader. What that means is I take trades as structure and I enter as structure, I place my stops as structure, and I take my targets as structure as well. But I found that I made a little tweak to just like cut down my stop loss and increase my targets. I'm gonna jump into the charts and show you so it doesn't get too complicated. Okay, so just to explain the concept, I'm gonna start from scratch, right? So we're just gonna look at how to read a regular price chart, right? So a lot of you know that market ebbs and flows. It goes up, goes down, it goes sideways, all right? Uptrend, downtrend, and consolidation, right? So let's just look at an uptrend here. A typical uptrend will have an impulse, it would have a retracement, and they will have another impulse that breaks structure, looking left, see? It will break that structure right here. And then it will come back to retest that structure or break past it to retest this structure. And as long as we don't break and close below this structure right here, this is still an uptrend. And it will break to the upside again, another impulse, come back, retest structure, and then break to the upside again, and then retest structure, and so on and so forth. So if you look back to my previous videos, what I've normally done is I would look at this structure and I would identify that the market is trending. And what I would do was to come in here and look for my reasons for entry. Usually it would be a double bottom or a double top or something like that. What it is really irrelevant. As long as you can read the price chart, your entry signals, as long as they make money, if you've back tested it, it's really not that important. Right, so what I would do is I would come in here, I would look at the price chart and I would say this would be my structure level. So this would be the area I would be looking to get into the trade, right? Because this is the structure level and structure always attracts structure, right? It's like a magnet. So in here is where I'll be looking for my reasons to enter. But unfortunately, if you look at this structure level, it's trending, that's fine. But the problem here is if you put your risk to reward measure, I will be looking to take targets at the previous level of structure, which is up here. And I would be looking to put my stop loss below the previous level of structure, right? So if you look at this level here, you will be thinking, well, the market has every right to retrace past this level all the way down to here. And as long as we don't break past this level of structure, we are still in an uptrend. Well, that puts you in a kind of a pickle, because if you look at this now, you have to put your stops all the way below here for protection, right? Now, it doesn't take a genius to look at this and say, well, this is not a very, it's not a very nice risk to reward. And now you're risking like 1 to make less than 1. That's never going to be a good thing. You have to have at least a 1-to-1. That's a general rule. Doesn't have to be, it's not set in stone, all right? You can trade this, but it's just not in your favor. You really have to have a higher win percentage to make up for the fact that you're not even winning half of what you are risking, or just a little bit more than half, right? So you're taking targets at the previous level of structure and you're putting your stops below the break of structure right here. And you are putting yourself in a very, very negative risk to reward. And this is not going to be sustainable. Eventually, this is going to come back to bite you in the ass, right? So what we're looking to do here is essentially just reduce this. Very simple. I'm not breaking grounds here. You know, cut your losses short and let your winners run, essentially is what this video is about. So essentially, I'm just looking to reduce this as much as possible. Now, you might ask, well, if you actually reduce this, what if the market continues to trend and then breaks your stop? So if I'm looking to reduce, there's a reason why you put your stops below structure for protection, right? Because if the market is trending, it has every right to retrace back here and then keep going, right? So if you're going to push into that zone where the market has every right to retrace into, why would you do that? Well, I already explained that it's a shitty risk to reward, so it's stupid. And secondly, you can make up for that by increasing your target. And thirdly, if the market is going to stop us out, we want to get stopped out as quickly as possible. You don't need to win every trade, right? Even if it's a good trade, it can still get stopped out and it will still be a good trade. The thing is, we're looking to reduce our risk. Like, if what I'm going to pay for this trade is worth more than I have budgeted to pay, then I'm not going to take that trade. So if I'm looking to risk only like 20 pips on this trade and the market is looking to retrace 30 pips, it might still be a good trade, but it's not for me, right? So we're looking to cut losses short, right? So, and I will show you in a bit how we do that. So we're looking to, first of all, reduce. That's the first tweak, not the first week. So we're looking to reduce our stop. And you can see, if you, this is the reason why I love TradingView, guys. If you don't have TradingView, it's the GOAT. So it tells you exactly how much you're risking by pip, by percentage, and the risk to reward. Look at this risk to reward here. You're risking 1 to make 0.59. Now, look at what happens when we just pull this in. And this will make sense in a second, right? So we've gone from a risk to reward of 1 to 0.5 or 0.6. And now as we pull this up, look what happens to that number. And mind you, we haven't even touched the target. We're just reducing risk right now, which is probably one of the most important things. Because it doesn't matter how much you make. If you're losing more than you make, you're not going to be able to do business for very long. So we pulled this all the way up here. And we've gone from 0.5 to 2.3 or 2.4. That is crazy, right? So that means that you can actually take this trade more than twice and lose, only win once and still make money, right? I mean, hopefully this is you're putting this in perspective. Are you going to lose more trades? Probably, but who cares? If I'm going to take one trade and make 10x, I don't care if I lose half the time because I'm still making 10x on one trade, right? So you do the math. We're not doing that here today. So now that's the first week, pushing this, finding a way to push this up here, obviously within reason. I'm going to show you how to do that in a second, like I said, and then finding a way to essentially increase your target. We've essentially like flipped this all the way around. We started from a shitty situation looking like this to now kind of flipping around and putting ourselves in a very desirable situation now. We're risking 1 to make 5.7. Doesn't have to be 5.7 every time, but essentially you're looking to increase your target as much as possible while decreasing risk within reason. You don't want to get stopped out just by a couple of pips because you're being too careful and you're being fearful and then putting your stop so close to entry because you don't want to lose. You still want to be sensible, but it doesn't have to be all the way below down here. That would be ridiculous. You're kind of fighting the tide, right? Now let me show you how to do this. Okay, so this is my backtesting results. Well, this is my backtesting chart. This is Aussie yen on the 1 hour. And we already did a price chart here. If you look at this price chart, you can very easily tell, well, let's just scroll to the left a bit. If you look at the price chart this way, you can very easily tell that this is a downtrend, right? Because you can see the market is clearly trending downwards. I chose this example because it's very, very clear. I don't want to complicate things here. This is not the video for reading the price chart. All I'm looking to do now is to increase your profit, make you more money essentially. Okay, you're welcome. Okay, so reading the price chart, very simple way to figure out if the market is trending to the downside or to the upside is to look at which way it's moving. It's really dead simple, stupid simple, right? You can see the market is moving from the top left to the bottom right. That is a downtrend. And then eventually we have a break of structure. You can see I actually took a trade here. Well, I didn't take a trade, but I would have taken a trade here. And I'm sure I did in 2020 when this happened. But this is a backtesting result. So these results are not, how do they say it? Past result doesn't, I don't know, whatever, fuck it. But yeah, anyways, we had a break of structure here and the market is not in an uptrend. And then like I showed in the example, all we're looking for is for the market to give us an impulse, a retracement back to structure, and a new impulse. That's it. Impulse, retracement, impulse, retracement, impulse, retracement. That is a trend, right? So we had a break of trend here. The market came down, came back to retest, did not put a new structure low, did not put a new impulse to the downside. Instead, we had a new impulse to the upside. What does that mean? We broke and closed above the previous level of structure right here. So that puts us in notice that we are now in an uptrend. Now, all you have to do is figure out where the structure level is. I've drawn it in for you neatly here. You can see if you scroll back a bit, you can see market tested here, tested here, tested here. So this is a very strong level of structure. And if you go onto the daily, it's even more prominent there, right? So that's how you know this is a very good level, because there's been multiple tests of it, right? So market breaks and closes above that previous level of structure, and then comes back to retest that same level of structure, okay? Now this is where we're looking to get in. Now previously, what I would have done is I would have put my stops all the way down here. You know, I used to use an ATR stop, right? I used to use an ATR stop, and I would put my stop clearly below the structure level because I was trying to protect myself. And that's a good thing. Again, you don't want to put your stop very, very close to your target, but you want to find that middle ground. You want to find that good ground where you're not too far away that you're risking too much, and not too close that you can get stopped out by, you know, market manipulation, right? So again, go back and do the back testing. This is just my results. Don't do what I do. Just go back and test it yourself. But you will find that the more you reduce your risk, the more money you make. I know it sounds a bit silly because duh, right? But what we've done here is that we've recognized that this is the structure level. I've waited for the market to come back down. I've found my reason for entry, which is a double bottom. Again, you can see I have results for both. I have a results for a double bottom here. You can see the two arrows I put in here. This is a double bottom. And guys, again, quick tip: if you're doing the back testing, figure out everything you want to test and test it once. It's nothing worse than doing weeks of back testing and then realizing you've missed something. Then you have to go back and do it again. So anyway, little segue. So figure out this is the structure level. This is our entry point, the candle right here. You know, I use a H3C or higher high, higher close candle, or L3C, lower low, lower close candle. If you don't know what that is, check. I'm gonna put some videos in the description, or you know, check out my previous videos. You will find exactly what I mean by that. So essentially, what I'm trying to say is this is my entry. My entry was right here. And my target would, my previous trading style would have had my entry here, my target here, and my target here, and my stops all down here, all the way down here, right? Now let me show you a little tweak. Now what we've done is I've back tested, instead of having an ATR stop, I've back tested a little bit more of a tight stop, right? Now again, go back and back test this, because you can have your stop too tight and get stopped out every time. There's nothing worse than that, because you're still going to lose money. You're just going to lose it quicker. So what I've done is from here now, I've measured 20 pips. 20 pip stop. Very simple. Again, I'm not breaking grounds here. Measure 20 pips. Go all the way down. When you get to 20, that's where your target would be. That's where your stop loss would be, sorry. So your stop loss would be right here. I know it's not much, it's literally like fraction of a percentage, but what you need to realize is that over time, over dozens and dozens and dozens of trades, that adds up. Okay, so you've done, that's the first tweak you've done. So as opposed to my target, actually my stop loss would have been much lower, because I'm very risk averse. I don't like losing, right? It's not a nice feeling. So I'm very risk averse. I'm a very conservative trader. But what you can do is, if you have the balls for it, is to have a little bit more. And how do you get the ball? How do you get the confidence for it? It's by backtesting, doing this boring stuff that I'm doing right now, drawing lines on the chart, putting it on Excel, using Notion, taking screenshots. That's how you get the confidence, right? So what I do is I take my ruler and I draw 20 pips from here, and that's where my stop loss is. And then now this is where the magic happens, okay? So as opposed to before, where I would put my stop here and put my target here, this would have been a nice cheeky 2.5 to 1 risk to reward. Not too bad. It's actually decent, very decent. But we're trying to maximize profit here. Now, how do we do that? That's where the concept of trend following comes. So they say you should let your winners run. It's exactly what we're doing here, and this is how you do it. So we've established this is a what do you call it? It's the word. Fuck. Uptrend. Fucking hell. Okay, this is an uptrend, right? So if this is a trend, then it will be trending, because that's what trends do. They trend. By the way, look at how close this was to my stop loss. This is why you need to have balls of steel as a trader, because this would happen more often than not. Market came, and this is my entry, came down, retested, came up, all the way up, almost to my target, and then moved sideways for a few days. Yeah, moved sideways for like 3 days and almost stopped me out. So again, these are the movies I play in my head to let me realize that this is the real deal, because this is what happens in real life. Anyways, again, target was here, but now since we are in a trend, we are going to follow the trend. That's it. That's what trend following is. You just follow the trend until the trend stops. So I told you earlier that the market trends, retraces, it trends, retraces, it trends. And all we're doing is just following this. And at every break of structure, we just move our stop loss. So when we make a new structure high, and we make a retracement, and we make a new structure high, we make a retracement, we just move the stop loss from here to here to here. So you just keep following it. So you can literally be in a trade for weeks and you have locked in profit. You know you're going to make money, and now you're just playing with house money. There's nothing feels better than being in a trade that is like making you 7x what the other trade is losing. So you can be in a trade, you can be in 4 trades and 3 of them are losing like 20 pounds each. So you're going to lose 60 pounds max on these trades. But the 4th trade is already like 140 pounds in profit. And there's no way it can turn around and stop you out. There's a massive, massive release of confidence that comes with that, because now you don't care. You don't need it. You've reduced the importance. It doesn't matter anymore, because even if you lose, the worst case scenario is not going to be as bad as it could have been, because now you have so much more money in profit. So you're making 140 pounds and you're losing 60 pounds. So you're still making 80 pounds in the worst case scenario, right? So it's kind of like a psychological trick that helps you stay consistent, and it reduces the need, the fear of missing out and the fear of losing, because you're not losing, you still have so much money, right? I don't know if that makes sense, but that's just how I think about it. So now we're just following the trend. So we already established this is an uptrend. So, okay, cool. So now we're just following the trend, right? So now we're just figuring out, okay, well, this is an uptrend, and where does it end? Right? You can see the market has put in a new structure high, retraced. And this is the beauty of it, because you can actually be in one trade and get a signal for another trade. Remember I told you how we look for a new structure high and a retracement, and then you can see another trade has just matured here. Again, now we're in 2 trades. So now we do again, which is going to be a trend following trade. So now we're just looking to follow the trend. And guess what? There's a 3rd trade. Again, market broke to the upside, came back to retest. Look at the major level of structure. Now we're in 3 trades, which are all in profit. And the market is just trending, right? All we're looking for is just to move the stop loss to the next level of structure as we trade. So now let me give you a little tweak to this. The downside to this is that you cannot, and this might be a little bit complicated, you cannot put your stop loss, or you cannot put your target somewhere that gives you you cannot put your target somewhere in an area that gives you a return lower than you would have if you had just taken the target here. So if this was going to give me like 136 pips, 137 pips according to this one, you can't move your stop, you can't move your target below that. You might as well, you have to let it get to a place that it will give you a higher return, right? So what do I mean by that? So now we have a new structure high here. I'm not going to move my target to this level to this stop, right? That doesn't make any sense, because then we're just going to lose. So I have to make sure that the market breaks and closes above enough that I can safely move my stop above this target, and still, as long as I'm still making this amount of money minimum, that's a good thing, right? So this is a little side note. I didn't really understand this. I remember when I was studying trend following back in the day, I didn't really get this, and that's why why I became a trend continuation trader. So you can see we are now in 3 trades, all in profit, all following the trend, and the market is still trending, it's still moving. So again, we're just following the trend. So now the initial trade, you can see we have broken and closed well above the previous level of structure. So now my stop loss has moved from here to this price level here, right? As we move and we make a new level of structure, we make a new structure high, my stop loss moves here. So now this trade has moved from 137. If we move it up a bit, now we make it 180. And as we move up, we make it more. And we've gone from a 2.2 risk to reward. Now we're moving up to a 3, to a 4, to a 5, to a 6. It's really that simple. That's it. It's crazy how much money. The downside to this is that you might have to wait a while. You might take a few more losses. But again, if you do the math, if I can get this trade to a 7x, all you have to do is just take one trade that wins and you will still make money. That is a shitty return. That is a shitty win percentage if you're only winning 1 out of 7 trades. But that's all it will take, right? So let me just show you the final form of these trades. So eventually the market kept trending and trending and trending until we got to a certain point. It's a very good example because it's not always going to happen like this. Now look what happened here. Market, we started off from all the way down here, right? The market kept trending, 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 and then eventually we had a new structure high. You can see if we just look at it again, let me just one more time. A new structure high, retracement, a new structure high, retracement, a new structure high, retracement, new structure high, retracement. And then we had a new structure high, bear with me, retracement. And then finally, we had a new structure high right here. And you can see a new structure high here. And you can see right here, the market came back and instead of testing that structure level, I just draw it in so you can see it. You can see the structure level right there. Market came back to retest that structure level and instead of continuing to a new structure high, it came back and broke below that structure level. So now, if you're looking at those free trades, these free lines essentially denotes the free trades. The initial trade that we started off at 2.2 risk to reward at 433 pips. If we just pull this reward up, we've gone from a 2.2 to a 12.3. But remember, we were in 3 trades. So the second trade had gone from a 2.2 again for 224 pips to, again, if we put it up there, to a 7.2. And the third one had gone from a 6.3 risk to reward to a 31 risk to reward. This is how money is made. Now, these kind of trades don't come along all the time, but again, that's where patience comes in as a trader. So we've gone from a 6 or 7, or maybe maybe like a 10 to 1 return on investment, to essentially, what is it, 12 plus 7 plus 30. I don't even know how much that is, but that's a ridiculous return on investment. So guys, that will be the end of the video. I think this is run for a little bit too long, but yeah, that's pretty much it. I hope you guys go and put this into I hope you guys go and do your own back test. Again, don't just trade it because I said so. Go and do the back testing, build the confidence by seeing it for yourself, and then you'll see what I mean. All right, so guys, that is the end of the video. So you know what to do. Like and subscribe. Do the thing, like Julie. And just so you know, spaces are open if you want to have a one-to-one consult with me. If you're having trouble with your trading and you need help, all right, and you need to be a smarter trader. I'm just joking. But seriously, if you want to have a chat with me, there's a link in the description for my calendar. Book a call and we'll have a chat soon, okay? All right, guys. Take care. Bye.